Hello, and welcome back to Easy Finance News. I'm Fiona Finance. Today, we will discuss a major move by McDonald's that has everyone talking. The fast food giant has decided to buy back all 225 of its franchise restaurants in Israel. This decision comes after significant boycotts and protests. The Israeli franchisee, Aloniel, announced it would donate free meals to the Israeli military amid the Gaza conflict, leading to backlash in several markets, especially in the Middle East. In this video, we delve into the potential consequences of this move on the company's finances. To shed light on the matter, we will dive into McDonald's history and examine how similar moves in the past have impacted the company. Here we don't just report the news, we decode it. Every decision a company makes has an impact on the company's finances. From strategic pivots to product launches, each move has a ripple effect on stock prices, revenue streams, and investor portfolios. Whether you're a seasoned investor or just curious, our content empowers you to see beyond headlines. Remember, knowledge is your best investment. Click subscribe and let's explore the financial world together.
Hello everyone, I'm Lionel Ledger. McDonald's has a history of making strategic acquisitions and divestitures. For instance, in 2017, McDonald's sold its controlling stake in McDonald's China to a group of investors led by state-owned Chinese conglomerate CITIC and Washington-based private equity firm, the Carlyle Group, leaving McDonald's with a 20% stake in the business.
Here it is worth mentioning that this decision supports business's long-term goal. In an annual report 2017, the management states that for optimized mix of company-owned and franchised restaurants is approximately 95% franchised and 5% company-owned.
This move positively impacted its financial statements. Despite the decline in revenue, the operating income increased by 23% that year. The reason being mainly recognition of gain from sales of restaurant businesses and decreasing operating expenses. Excluding effects of this transaction, the increase would have been 17%.
Why operating income, Lionel, and not gain from sale of assets?
Good question, Fiona. McDonald's reports gain on sales of restaurant businesses as operating income because these transactions are a recurring part of their business.
When it comes to cash flow statement, the sale of China and Hong Kong businesses resulted to cash inflow from investing activities. These moves often lead to fluctuations in McDonald's financial performance. The sale of McDonald's China businesses helped boost their free cash flow and overall profitability. Now let's return to today's topic. McDonald's decision to buy back its Israeli franchise is a strategic move to regain control and mitigate the negative impact of boycotts. While it may pose short-term financial challenges, McDonald's has a track record of navigating such complexities successfully.
Let's look at the possible financial impacts of this decision on McDonald's income statement, balance sheet, and cash flow statement. Again, please keep in mind that these are possible outcomes and actual outcomes may differ, as they depend also on myriads of other factors.
Starting with the income statement, the sale of McDonald's in China reduced revenue from that region and significantly cut operational expenses, increasing net income. On the other hand, the acquisition of the Israeli franchise will likely increase revenue but also add operational costs, potentially reducing net income in the short term.
On the balance sheet, the sale of McDonald's China improved the company's asset turnover ratio and reduced liabilities, strengthening the overall financial position as assets and liabilities of businesses in China and Hong Kong were held on balance as businesses held for sale, and proceeds from their sales turned into cash balance. Conversely, the acquisition of the Israeli franchise will increase assets but also add liabilities, impacting the debt-to-equity ratio.
For the cash flow statement, the sale of McDonald's China boosted cash flow from investing activities due to the inflow of cash from the sale. The acquisition of the Israeli franchise will result in a cash outflow, impacting cash flow from investing activities. That's all for today's video. What do you think about McDonald's latest move? Let us know in the comments below.
Don't forget to like, share, and subscribe for more updates on the business world. See you next time.